So dividend stocks versus growth stocks. Now, when it comes to dividend paying stocks, I also call those income stocks. These are stocks that are a lot more stable when you look at their price fluctuations on the stock market. And of course, a dividend paying stock pays you as a shareholder an income on a frequent basis. Usually in the US, it's quarterly. Some examples are, of course, McDonald's, Johnson& and Johnson, Procter& and Gamble, even Walmart. Now, growth stocks are stocks that are a lot more volatile when you look at their performance on the market, but the underlying companies focus on growth. So, all the revenue that these companies generate is put back into the company in order to grow the company as fast as possible. Some examples are going to be your Teslas, Google, Facebook, Twitter. So, which one is better, dividend paying stocks or growth stocks? Me personally, I prefer dividend paying stocks, but there are no rules that say that you can only have one or the other. You can have both in your portfolio. So, if you're an investor and you're thinking about it, which one should I get? Get both. So whenever we talk about growth or income stocks, you always want to think about the business life cycle that this particular business is in that you are planning to invest in. So for example, a business always starts out as an idea in the mind of its creator. It's at that idea process that this creator will look for other people that believe in this idea and they can work as a group on this business in order to form a startup. When a business moves from an idea to a startup, and it's a good idea, it's a good business, this business might also attract some capital from angel investors and capital and venture capitalists. Once some of the kinks are worked out, this business shifts from the startup phase into the growth phase. It's in the growth phase that the business wants to expand as much as possible. So expanding might mean anything from expanding into different countries, expanding into different states. It might also mean generating a lot more capital so the business can spend more money on research and development. It might also mean attracting the best and the most qualified people to work for the company. It's also in the growth phase that a company might go from being a private company to being a public company through an IPO, like we previously talked about. So it's at that growth phase where you can see companies, a lot of tech companies like Twitter, Facebook, Snapchat. After the growth phase, a company shifts more towards and actually shifts into a maturity stage, a mature stage. This is where a company has worked out all the kinks. It's a stable company. Customers know what they can expect from their products or services. It's a very stable company, usually called a blue chip company. These are mostly companies that are going to be paying a dividend. So think about your Walmarts, your Targets, your McDonald's. Those companies are always in the maturity stage. They are the market leaders in their space. After the maturity stage, there is a decline stage. So what's the decline stage? The decline stage is where customers don't want the products or services that a company sells anymore. It's pretty much obsolete. Think about the cassette player. Think about the Walkman. Even think about Blockbuster. Like nobody goes to Blockbuster. They went bankrupt because everybody's watching Netflix. So if you're not the type of person who likes to look and pick and choose individual stocks, you can always look into mutual funds and even index funds or ETFs. That's what I would recommend. So one site that you can go to, and you can also do this on Yahoo Finance, but I like to use Morningstar. Let's say there is a particular mutual fund or index fund that you want to analyze. You can type in the ticker symbol in here. I'm just going to type in the one that I invested in, which is the Vanguard 500. And on Morningstar, you will be able to see some pretty cool things. If you plug in the ticker symbol, first thing you will see is the rating that Morningstar gives it. I don't necessarily know how accurate this is or how good this is, so I usually just skip this. It's fun to look at, but okay. So what I do pay attention to is the expense ratio, so how much I would have to pay in expenses, and the minimal or the minimum investment, which in for the Vanguard 500 is which is $3,000, of course. And another thing, just going and looking at each individual tab, when you look at performance, of course, the S&P 500 tracks fund index fund tracks the S&P 500, so it should be pretty spot on. It mirrors it. So this is something that I always pay attention to. If the mutual fund or the index fund that you are planning on buying, is it performing better or worse than the benchmark? When it comes to risk, so you can see the beta that we talked to, and since this is an index fund for the S&P 500, the beta is going to be the benchmark, which is 1. So get price. So interesting thing about when you go to the price tab is that you can see other fees associated with this index fund. So now if you plugged in a mutual fund, you might see some additional fees in this section and some taxes also. So got portfolio. So portfolio is also interesting because portfolio shows you the different asset classes, and you can see that with the Vanguard 500, about 99% of it is invested in US companies, which is something that I of course already know because the S&P 500 consists of the biggest 500 companies in the US. And then one cool thing is you can also see which companies you are actually investing in. Now you won't see all of them, but you will see that Apple takes up most of the weight when you invest in this particular index fund. But if you really want to know about this particular one, just look for the S&P 500 companies. And then it's also good to look at the people because you can see the management team. And if you click on a person's name, you can see how long they've been in the business, how long they've been managing investment accounts or investment funds, and which ones they've actually been managing or are currently managing. So for example, let's say you looked at a mutual fund and you saw a somebody that manages this mutual fund, but they've only been on the scene for like a year or 2 years. You might not have that much confidence in them, so you might want to skip that mutual fund and look for a fund that has a team member that has been investing for a longer time. I visit this website daily or whenever the market is open, of course, just to see how the overall market is trending or performing. So of course, you can look at the Dow Jones index or you can look at the Nasdaq, but I primarily focus on the S&P 500. So the first thing that I do when I get to the website is I click on this chart right here. This chart shows me all the 500 companies in the S&P 500 and how they performed compared to the previous day close. So if it's red, it underperformed the previous day's close, and if it's green, it performed better than the previous day's close. Just cool to look at. I don't do a lot with it, but it's still fun to look at. Something that they recently introduced was this bubbles chart. So there's different filters that you can mess around with. I don't really look at this. The thing that I focus on is if you go to futures, you can see all the indices. If you're somebody who's interested in currencies and commodities, you can also take a peek at these. I like to look at the S&P 500 performance. So when I click on this, this will give me a nice chart to look at to see how the S&P 500 is performing on a daily basis. So I can change the date range up here. So if I change it to the maximum date range that they give us access to, I can see that in 2000 there was a market crash. And then, of course, in 2008, there was also a market crash. And the market crash in 2008, we've been able to pick up and recover from that crash in 2013. And we've passed it like crazy. ever since 2014, 2013. And of course, recently in March, we also saw some turbulence again, but we've been able to pick up and we passed it in August. In the last few days, yes, there's been a dip again, but we'll see how the market performs going forward. So this is a really good way of just looking to see like, okay, how's the overall market trending? Just log in every single day, see what the market is doing, and you'll like this website just as much as I do. So as I stated earlier, I started out by buying an index fund, which was the S&P 500 from Vanguard. After I bought my first index fund and I got familiar with kind of how the stock market worked, that's when I started learning and teaching myself about fundamental analysis, which allowed me to pick and choose individual stocks which worked best for my investment account. And after I taught myself about fundamental analysis, I noticed one thing. I noticed that whenever I would buy a stock, immediately the stock would go down in price. I'm like, this is something that I did not like. So that's when I started looking into day trading. And I'm not a day trader, but I do use some of the day trading techniques, especially when I'm buying stocks. These are topics that I will discuss on a different time, on a different day. So I hope you enjoyed this topic today about stock market investing for beginners. Let me know what you thought about it. Let me know if you got motivated to start investing, and I'll catch you guys in the next one.